Hello, and welcome to today's webcast, Mark-to-Market Instruments on Your Balance Sheet. Before we begin, I am going to play a brief housekeeping video.
Welcome and thanks for joining us. Moss Adams webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% or 3 of the 4 polling questions, which we'll ask throughout today's presentation. Polling questions will appear within the slide window. To participate in the polls, please click on your answer and be sure to hit the Submit button to record your response. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry, if you can't download your CPE certificate today, we'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our group CPE attendance sheet to receive credit. The attendance sheet is available in our slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit only can be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Before we get started, I want to acknowledge our recent big news, that Moss Adams is joining forces with Baker Tilly to create a new firm, one designed to serve the needs of the middle market. This is really exciting, and you can read more about it on our website from the link in the console. With that, I will turn it over to the presenters to introduce themselves and get us started. AJ?
Thanks, Laura. Welcome to our webcast. We're excited to have you here. Well, good morning, good afternoon, good evening. We saw some international people registering, so that's pretty cool, all the way from Asia, UK, and Canada. Hi, I'm AJ. I'm a director at Moss Adams. I have over 15 years of experience in consulting, and I'm mainly focused on the energy industry. I also help the company with building out, strengthening, and adding service lines within valuation. And today, our focus is going to be on complex financial instruments, which is going to be relevant to our webcast. Joining me is Adriana. I'm very excited to have her here. She has very relevant experience that's going to help us with this webcast as well.
Hi, everyone. I'm Adriana Langston, and I am a manager in our valuation group. As AJ says, I have prior experience that is very relevant for today. I previously worked for an energy trader reviewing mark-to-market, so I'm happy to share that experience with you. Thank you so much for joining us.
Yeah, so what inspired this webcast for us has been our career trajectory. It's given us this unique exposure of the information that clients are needing so that their reporting needs can be smoother. So the layout of this webcast is pretty intentional. First, we're going to give you that mark-to-market, fair value, market participant overview, and then we're going to take you behind the scenes and go through the instruments on the balance sheet so that you can see how we categorize it. That's essentially going to make the process a lot less abstract. And then we're going to jump to a specific instrument that we value from quarter to quarter. So you can understand what's driving the impact between those quarters. And then we're going to give you a cost comparison analysis. And essentially, it's going to help you understand how it's more cost efficient to use a third-party appraiser versus doing this in-house. And then we're going to wrap it up with fair value of hierarchy and open it up to questions if we have time. So Adriana, for people who are new to the concept of mark-to-market, market participant, or fair value, how would you introduce this to them?
Yeah, I would say in simple terms, mark-to-market is the value that speaks today. And we are following accounting guidance under AACA 20, IFRS 13, that defines fair value as the exit price in a normal sale between market participants. And market participant here is underlined because we spend a lot of time defining those market participants for fair value purposes. Those need to meet these 4 criteria on the screen. First, the market participant needs to be independent. It cannot be a related party. They need to be knowledgeable about the asset and the situation. And they need to be able, have the financial means to buy and sell these assets, and also willing. They want to transact, but they're not forced to do so. So a good example of a company that we would exclude from market participant would be a company going through bankruptcy, because any liquidation sale, any forced sale does not meet this criteria. And we've had some challenges defining market participants in a recent project, right, AJ?
Yeah, remember this quarter we worked on that lithium-ion recycling. We had to broaden our scope and find what metal recycling, but that wasn't sufficient. And so we had to broaden it more and get anyone that touched battery manufacturing to get sufficient market data. So market participant, that could be wide or narrow, dependent on what information you're getting.
That's right. Also with traditional oil and gas, with all the consolidation that's been happening, sometimes we have just a few public companies in certain areas. So we've had to expand our scope for those reasons too. So now that we know fair value is that exit price, when we say mark to market during this presentation, what we mean is we're updating the value in our balance sheet to reflect that exit price. And the good news is not everything needs to be marked to market. We have here a table that shows you different assets and liabilities. Everything you see on the top is going to be marked to market. It's all your financial instruments. And everything you see in the bottom, where it says no, is not marked to market because it's more physical in nature. So everything that you just deplete or amortize over time, you're not doing that exercise of mark to market. It's only for those things at the top. And here we wanted to call out the derivatives, because you will learn today that sometimes debt can have embedded derivatives, and those need to be marked to market. So today is your lucky day that you will learn to value that embedded derivative. And also we want to call out the earnouts, because sometimes people forget about them. They're looking at a transaction that has a contingent payment into it, and they forget that that component will need to be marked to market every period until that contingent payment is paid or it goes away. So please remember that if you're looking at an M&A deal right now. We also have a prior webcast we did where we explain how to value commodity derivatives. So if you're interested in learning more, please click at the link at the end of the presentation. It will take you there. And what if I don't know if something is a financial instrument? So if your company enters into a very special or new type of contract and you're not sure if you're going to need to mark to market, no worries. We have a really good team of technical accountants that can help you figure out that accounting treatment. So we got you covered there. And I think we're at our first polling question.
Thank you, Adriana. Polling question number 1. Does your business have assets or liabilities that require mark-to-market? A, yes. B, no. C, not sure. The polling questions are located right on the slides we are presenting. If you can't see the poll, you can hit the F5 key to refresh your console. To respond, please click the button next to the answer you choose and hit Submit. And we'll give everyone just a few more moments to respond. And here are the results.
All right, so majority of you is very relevant. And for the ones that responded not sure, we can definitely help you out with that question. So now that we learned our accounting concepts, let's dive into valuation. How do we determine that exit price and that fair value? So we have different valuation approaches that we apply. First, the income approach is where we take future cash flows and present value them to come up with the value of the asset. A good example, and everyone can relate to this, I think, it would be a mortgage, right? That's how you set up a mortgage for your house. And then what if a few years later you want to see what the value of your house is? Well, you can go to Zillow, look up recent sales or houses for sale in your neighborhood, and you can come up with the value for your house that way. Doing that would be applying the market approach, because you're using market indications. And then what if something really bad happens and your house burns down? Well, you can call your insurance and they might pay that replacement cost for your house. That would be the cost approach. We also have other quantitative methods we apply to value complex financial instruments. And today you will learn one of them, the modified binomial. But AJ, what is your favorite quantitative method?
I feel like I'm going to lose cool points admitting, but I really like the Monte Carlo with Cholesky decomposition matrix. I know it sounds made up, but I promise it exists. But what about you?
I'm a simple girl. I really like Black-Scholes model to value options. It's straightforward. I don't think anybody ever fights us on using that method, so that's why it's my favorite. But yeah, these are the valuation approaches. And choosing the valuation approach, it really depends on the situation and the information available. So I can't give you an answer that applies all of the time. So it really depends. And here we have a list of different assets and liabilities and the usual methods we apply. Here we want to highlight equity awards, because if you have an equity award that's classified as a liability, that will need to get marked to market. So if you're thinking about issuing these types of awards, think about the future reporting that you will have to do as well if it's a liability. But we can also help you with that. And AJ, what is something from the list that you recently valued?
Yeah, I don't see redeemable debt on here, but I did get a value that this year, and it had like 5 different embedded derivatives. It required a Black Dermond toy model. Unfortunately, we don't have time to talk about how we value those, but we're going to talk about the nicer brother here, the convertible debt, because it's easier to explain. So before we go to our next slide, I think we have one more polling question. So back to you, Laura.
All right, thank you. Polling question number 2. Does your company have convertible debt? A, yes. B, no. C, considering issuing. D, not applicable. Also, you do have the option to submit questions for the presenters in the Q&A window. We have quite a bit of content to cover today, so if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards. All right. We'll give people a few more moments to respond. And here are the results.
Yeah, this was expected. I didn't expect many people to have convertible debt, but I do want to share the relevance of it in today's market. Again, this is a very intentional pick for our webcast, the convertible debt. And really, I guess everyone on the audience is following with what's going on with the economy. Q1 GDP contracted by 0.3%. A lot of it had to do with imports that were coming in flux to avoid those tariffs. And also with the tariffs, we don't know what's going to happen there. I think the president yesterday, he announced that some of the tariffs are going to be permanent, and that could cause a short-term recession. So there's a lot of that recession fear in the market. But even experts, they don't know how the recession is going to hit or what the probability of it is, right? Like, for instance, Goldman Sachs last month, they put out a recession forecast of about 60%, and this was up from 20% from previous year. But then an hour later, they retracted it and they said, well, just kidding, actually, it's 45%. So there's a lot of uncertainty going on in the market. And for that reason, investors are being cautious and don't want to invest in equity financing, right? Because you don't want to get caught in that recession and have your equity value diminish. But companies, they do need that funding access because especially if you're an energy company, you need those hundreds of millions of dollars for your capital outlays. So you need some kind of financing. You can't do straight debt financing, but remember that we are in a very high interest rate market. So what is the compromise? The convertible debt, what it does is because you're adding that equity sweetener, it allows companies to negotiate rates to be a lot lower. So if your company is yielding 8 to 9%, which is going to be your cost of borrowing, if you just, issued a convertible debt instead, you're able to lower those interest rates by less than 4%. So imagine that, borrowing hundreds of millions of dollars, and you're more than doubling your savings on your interest payments. That's what the convertible debt does for you. And the nice part about it is also it's easy to issue compared to its equity counterpart, right? So you can also be flexible with it, whether you're doing make-whole premiums, down round provisions, various conversion features through change of control. You can get very creative and flexible, and it's easy to issue as well. So what about lenders and investors? Why would they go for those lower interest rates, right? Well, the reason is, they have to park their capital somewhere. They don't want to do it in equity because of all this uncertainty, but they can park it in a convertible debt. And what that does, it gives them that downside protection. So in markets where the equity value is diminishing, you have those certainty with fixed income payments and your principal to be paid out. Also, you're in first to get paid out before you're an equity holder. But you're not missing out on the upside potential because let's say that bull market hits, you can go around and convert and then realize that upside potential. So remember this, for companies, you're negotiating lower interest rates is easy for you to issue. For those lenders and investors, you have your downside protection during market uncertainty and then converting to get that equity upside during bull market. So it's a win-win situation for everyone. But what makes me smile about this slide is, Adriana, you told me this looks like I'm playing Uno. I do think convertible debt is like the card in the Uno deck. What do you think?
Yes, and I play a lot of Uno with my grandma. So whenever I see these colors, I always think of that game. But yeah, and also hearing you talk about what convertible debt does, I think about that wild card that gives you that superpower where you can change your strategy to a few different options. So it was pretty relatable to that.
Yeah, I think it's a fantastic analogy. If the player next to you is like the market and you don't know what card they're going to put, drop, well, you have that wild card convertible that can kind of get you out of most situations. So I think it's a great analogy. And it's for this reason that issuances for convertible debt has been climbing. So from 2022 to 2023, it's more than doubled. And then it was going strong even in 2024. There's also anticipation that issuances for 2025 is going to be strong because people are expecting those bond yields to increase in the market, as well as uncertainty that's looming. All of our numbers are directly from Bloomberg, by the way. How this is relevant to the energy industry is last year, I want to say around Q1 2024, we had some of the busiest issuances in the convertible debt market. And two of those issuers were NextEra Energy and Sunrun. So definitely being utilized by the energy industry. But I also think like it's the hot talk of the town from what you have told me.
Yes, yes. I was recently having dinner with a friend who is a CRO at a renewable company. And I was talking about the different instruments we value. But as soon as they say the words convertible debt, it really piqued her interest, and she wanted to see how we could help her with that. So definitely very relevant. But AJ, how do we value this convertible debt? Say you have a public company in a very simple scenario where they can either hold or convert. How will we value that?
Yeah. And I'm glad you made that distinction, public company, because the example that I have is for a public company. And for a public company convertible debt, we're using a modified binomial. So I'll make it as simple as possible. Okay, so binomial model, when are you using it? You're using it to value your American options because it allows you to exercise at any time. So when your stock price goes above your strike price, you're in the money and you probably exercise, right? Well, the binomial math, it basically tells you my stock price can take two paths. It can either go up or it can go down. And then those up movements are further branching out into its own up movement and down movement. And then the down movement is further branching out into its own up and down movement. And then you have it branching out constantly through the term of the instrument. So the word binomial, two up and down, and then branching out is the tree. That's why we call it a binomial tree. Why we call it a modified binomial is here you're not using it for an American option, you're using it for a convertible debt. So basically, like Adriana was saying, do I want to hold or convert? You're looking at your stock value and then you're looking at your debt value and you're thinking, do I want that downside protection that we talked about, or do I want that equity upside because we're in a bull market, and am I going to convert, right? So it's a simple math of max of hold versus convert. But what you're doing with the modified binomial as well, you're merging two different methodologies. You're merging your DCF, or your discounted cash flows, to your binomial. Now, if you've been a good student and taking notes, you would have seen that Adriana before, she said when you're valuing your mortgage, which is your debt, you're using that income approach. It's no different from the debt feature for this convertible debt. So you have your discounted cash flows for your straight debt, and then you're going to discount it back with the yield. But at the same time, you're checking each point time period and then comparing it to your stock price to see if you want to hold or convert. So to take a real example, or really a hypothetical example in this case, let's look at the hold value that I've highlighted here and then the conversion tree that's highlighted here. For each of those, for example, you look at the $76 conversion tree and the $100 conversion tree, it's a no-brainer, right? Like, and as an investor, you're going to hold because it's $100 is more value for you than $76. But on the same highlighted row, as the conversion option gains in value, you're suddenly going to convert. That's your upside potential with the convertible debt. So imagine doing that for each of this, your $100, your $199, like basically going all the way through the tree. And for each node, you're making the decisions, hold or convert, hold or convert. And then the math is going to do the probabilistic formula and discounting for you and figure out what that value is as of the valuation date. So really simply, you're looking at, am I holding or converting? So what is going to impact the value from quarter to quarter? A big one is going to be your stock price, because remember, we're in times of uncertainty. So let's say as of December, you have $100 as your strike price. What if the next quarter your stocks plummet because of a recession, right? And you're at $50. Well, if you have a good memory, you would see where you saw some of that conversion decisions taking place. And for those that forgot, just a quick look, you see the convert. Well, the next quarter for the same row, those decisions change to hold. That's basically your investor saying downside protection, hold, hold, hold. I don't want my value to go below below the principal, right? So that means if you had a decent conversion option value as of December, well, as of March, a lot of it diminished because you're not choosing that conversion decision. Volatility and risk-free rate also are drivers, and they go hand in hand. Higher the volatility, higher your stock price swinging up or down. But higher the volatility also means your conversion option is more valuable. And the reason is, think about it. The lowest your stock price can swing to is $0. But the highest your stock price can go is, well, sky's the limit. There's no cap. So when there's no cap on your upward movement, but your floor is $0, when you crank up that volatility, it's just going to give you mathematically more value to that conversion feature. Another impact is also your credit spread. Credit spread, you want to think about it as your bond yield. And what does Finance 101 tell you? When yields go up, bond value goes down, right? So credit spread is the same thing. It's part of your yield calculation. So when that credit spread goes up, the DCF that's using to value your straight debt feature, that value is going to go down because you're discounting it by a higher number. So these are all the driving impacts that you want to understand, because that's what's impacting your financials from quarter to quarter.
And AJ, in our illustration, we have the price going from 100 in December to 50 in January and March. Do you see those drastic movements?
Yeah, great question. So if we were to go as recent as the pandemic, right? Like, remember, we had a lot of clients as of 2019 that had this convertible debt, and the conversion option had a lot of value because stock markets were strong. But then February 2020 is when the COVID information hit and value for the stocks plummeted. And by March 31st, those values hadn't recovered because, we were in that pandemic recession. So the conversion option that had a strong value as of December, it almost diminished as of 3/31 because of the wild swings in the stock price. So this can certainly happen, especially during times of uncertainty. Great question.
That makes sense. But what about that other method, the Monte Carlo simulation? Why do we want to use binomial and not that one?
Yeah, great question. The reason is, although the Monte Carlo is one of my favorite models, I'm going to have I have to ditch it for simplicity, because with a binomial, it elegantly handles the hold and conversion feature, and the math is a lot more simple. So it kind of reminds me of a saying that my dad tells me all the time, where he says, don't bring a dynamite for a mosquito problem, right? And I'm usually like, yeah, whatever, Dad. But I completely get it in this situation, because that Monte Carlo is that dynamite that you don't need for a publicly traded company. You have a use case for it more for like the private companies that have very complex waterfall functions that would need that by Monte Carlo, but you can get away with a simpler model with the binomial. That's one reason. The other reason as well is transparency in reporting. So if I were to take you to this page again and show you, well, I have $38 and I have $100, what are you going to choose? Instantly, you're going to say, I want to hold at $100 because converting at $38 is less money. So why would I do that, right? So the decisions being made are right on that page and it's transparent. Whereas with the Monte Carlo, the decisions are not being made where the modeling is done. It's done at the back end where the simulations are being run. So for me to understand where the decisions are being made and how impactful it is, I'm going to have to pull 100,000 different simulation reports and kind of compare and contrast to understand what's going on. So it's a lot less transparent. So when auditors prefer the binomial for a public company. Also, the other reason is calibrating data. A lot of times clients call me and they say, well, AJ, I want to know the sensitivity. What if I, change the stock price or the volatility or the risk-free rate or the credit spread? AJ, what is that going to do to my value? Well, we can get on a call and I'm going to share the screen and then input those numbers, and then instantly you're going to get an output, right? So it's that easy for me to show you. But if I had a Monte Carlo and you ask me, I'm going to hang up on you. Not to be rude or not because I don't want to talk to you, but because it's going to take me hours to run those simulations, and I'm going to have to wait until those simulations run and end, review those outputs, and and then call you back. So remember this, these are the reasons that you're using a binomial. It's just simpler and more transparent and easier to calibrate.
Yeah, no, that makes a lot of sense, that transparency. So now that we know the math and those valuation inputs that we need for the binomial, can people in the audience do a binomial in-house, or what are the resources needed for it?
Yeah, great question. Well, if my 10-minute explanation of binomials already made you an expert, well, send me your resume because I kind of want to hire you. But for the people that, are still confused and still want to know how to do this in-house, it's going to take two things. Remember the inputs that I talked about, the volatility, the risk-free rate, credit spread and whatnot. The easier inputs, the volatility and the risk-free rate and general yield movements, Capital IQ is going to give you that information instantly. Okay, and it's supportable, so your auditors are going to be happy. Bloomberg is going to give you the traded value of the convertible debt if that's available, which it frequently isn't, but also give you that credit spread data that's specific to that industry, like renewables, power, and utilities, right? Capital IQ is not going to give you that. So you're going to need Bloomberg. So you're going to need both those subscriptions, but getting the data alone is not going to build the model for you. So you're going to need someone with an advanced math degree or statistics degree that can do the complex math modeling for you. And you are, all these companies are very well run. They have their risk management in place. So they're not going to have one person dealing with such a complex model without someone checking it. So you're probably going to have a small team of experts. So you're going to need subscriptions and expertise. Right? So then the real question is this cost efficient? And I feel like next slide is going to be the most important slide for a webcast, because all of us have a little bit of Tom Cruise in us, right? Where we're like, show me the money, right?
Yeah, I don't want anybody in the audience screaming at us because we're just talking qualitative stuff and they want to know what the impact is in the numbers.
Yeah, so let's get ready. So what is this going to cost me? Well, if you have an expert, you're going to pay them and that team, right? So 150 grand for the expert and 75K for one other support staff to check everything. You're in for 225,000. And then the lowest end of the subscriptions is going to cost you 60 grand. So for that example that I showed you, to do it in-house, it's going to cost you $285,000 and up. However, if you use an appraiser like Moss Adams, we come in less than 85 grand, right? And that's going to get cheaper the next year because the 30K in initial fee is going to be dropped down to an update fee. So it's going to get cheaper as well. But if you're doing this in-house, the next year, what's going to happen? Your employees are going to say, hey, where's my raise? And healthcare is not cheap either. So those costs are going to continue to climb for you, whereas it's more cost efficient. Another point that I want to make that's not on the slide are your auditor fees. Whenever you do something in-house that's very complex, auditors' red flags go up, and they're going to have to spend more time, resources, and added scrutiny to get comfortable with that. Auditors are your friends, okay? They are trying to be cost efficient, but they do need to balance it with making sure you're reporting things correctly. So when they have all this added scrutiny that's adding to their time and money, they're graciously going to pass those fees to you. So it's just going to get more expensive. Whereas when they see someone like Moss Adams doing the analysis, they've seen our work. They know what our product looks like. It's, they're familiar with it. So it's going to be a lot less time spent. And those audit fees are, again, going to be, the savings are going to be passed to you. With that, we have one more polling question. So back to you, Laura.
Okay, great. Polling question number 3. After today, I plan to make changes to my valuation approach. Oh, actually, I'm sorry. Okay, it's A, yes, B, no, or C, I still need information. Actually, I'm so sorry. It looks like we went to results first. So here we go. Now we're on the right screen. Is everyone to answer polling question number 3? As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. We'll give people a little bit extra time. All right. Sorry about the confusion, but looks like we have a good amount of people who have submitted answers. So try to go to the results. There we go.
Well, for the people that need more information, well, Adriana, why don't you hit them with that fair value of hierarchy?
Yes, and please send us your Q&A if you have anything on the binomial or anything we covered so far that you would like us to bring it up live. I think we have a minute or 2 perhaps. But yeah, fair value hierarchy, remember in the beginning, we talked about accounting guidance, AACA 20, IFRS 13. Well, there's another concept that's also mentioned in there that we need to follow. So fair value hierarchy, what it says is when I value something, I need to prioritize using level 1 inputs first and level 3 inputs last. So using the example we just did with our binomial model, remember you had your stock price, your volatility, your risk-free rate, and your credit spread. Each of these inputs can be categorized as level 1, 2, or 3, depending on how observable that input is. So for that public company, that quoted price for the stock today, that's very observable. That will be a level 1 input. But in that same example, what if my stock is more over the counter, there's no volumes and no trading? That is less observable. So then I'm going to categorize that input as level 2. And then in my binomial, I also need the volatility, and that will be categorized as level 3 because it's an assumption that I'm making internally based on what I think the historical stock movement has been or another method. So for those reasons, it's level 3. And a lot of our complex securities are going to be level 3 because there's a lot of internal inputs that we have to use to figure those values. So remember that. And why do I care if it's 1, 2, or 3, right? Well, if you look at a company reporting big gains from level 3 assets, you would take that with a grain of salt because you know that a lot of the value was driven by an internal assumption and not a quoted price that everybody can see. And the opposite is true if you see somebody reporting big gains from level 1 assets that change in value. So for those reasons, it's important to prioritize level 1. We all want to have good financial reporting, and we want to have that trust and credibility from our stakeholders.
I thought what's interesting was, Adriana, when you were doing this at Macquarie, there's a lot of subjectivity of what you would put to level 2 and level 3, right? We say quoted price here, but then remember you were telling me about uranium futures that had a quoted price, but it was actually level 3. Could you elaborate a bit on that?
Yeah, that was a very, very interesting type of commodity or business. So, say you have a forward contract, you know what the spot price of the commodity is, but there's not really a futures market, right, to tell you what is going to be that price of that commodity in the future. And you have some long dated contracts, then that will be classified as level 3 because you are going to make a lot of assumptions to derive that future price. So yeah, very, very interesting. We have another fun question that is very relevant for all of our oil and gas people attending today. If you're looking at the stars and thinking, is PV10 for value? The answer to that is no. And please do us a favor and never use that SEC pricing for fair value. Why not? Okay, the SEC pricing is a 12-month historical price. It would be like trying to sell your car for what you bought it at the dealership 2 years ago. Like, that's not the value of your car now. So the similar thing happens here. I don't think anybody in the audience is paying $80 per barrel right now, right? We're all, buying and selling at 60, the current price. So the SEC pricing, especially today, will be overstating those volumes and the pricing. Now, what about the other type of PV10, that strip pricing from the futures curve? Well, there your volumes will be okay, but then you're not adjusting for G&A cost or inflation. So it might be a little bit off. But the most important distinction there is, by definition, PV10 discounts everything at 10%, and a lot of times our undeveloped and unproved reserves are going to be way overstated if we discount at 10%. So that risk adjustment is needed to bring those value of the oil reserves to fair value. So we can definitely help you if you're still struggling with the value of your oil and gas reserves. But yeah, please don't use the SEC pricing. And Laura, I think we have our final poll question.
All right, yes. Okay, this seems like it's the right slide. Polling question number 4. How confident are you that your current valuations would hold up under scrutiny? A, very confident. B, somewhat confident. C, I face challenges with fair value. D, not applicable. For those of you that would like a copy of today's slides, you can download them from the folder that says Slide Deck and Handouts. We will also be sending them out via email tomorrow, along with a recording of the webcast. Once you have completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window. All right, we'll give people a few more moments to respond. And here are the results.
Adriana, I think, what do you think?
How do I think is going? Well, I hope none of you were scared that we were going to report you to some of our independent. We're not going to report you to the SEC if you say you face challenges. It's okay. It's okay. So I hope everybody was very honest. I mean, if you're very confident, that's awesome. If you're somewhat confident and face challenges, we're here to help you. So yeah, no, we can get things a little bit better for you. But yeah, so just to summarize what we've learned today, first we learned our accounting standards. We learned that we need to market financial instruments using those level 1 inputs. And if you're still curious about fair value hierarchy, look out at a 10K for a public company, scroll all the way down to the SEC disclosure for fair value measurement, and you will see a section that's called fair value hierarchy. You'll see how everything gets put into those 3 buckets. It's a fun exercise if you're still curious about fair value hierarchy. But yeah, definitely prioritize using your level 1 inputs, because that will give a lot more credibility to your valuations. And we also learned the very relevant and important convertible note and how to value it using that modified binomial. And also the benefits of using a third-party appraiser, right? So if I have some financial instruments that are level 3 because they require a lot of judgment and a lot of internal inputs, using that third-party appraiser will give a lot of more credibility to the financial reporting. And AJ, what were your takeaways of today?
Yeah, and it's nice that we get these Q&A from our audience. Thank you for being proactive on that. But yeah, a part of my takeaway is going to be answering some of the Q&A because it's going to weave in nicely. So one of you asked if you can assign this valuation to your auditor. If you're getting audited by the company, then they can't do the valuation for you, but auditors can refer you to other appraisers that are third party. So great question. So with that, I really, I guess the takeaway is be proactive. Like when you are issuing these instruments with derivatives, engage your auditor and let them know. It can be a simple call where you're saying, hey, I'm doing this debt. I'm issuing this debt. I'm going to have these features. Are there going to be valuation consequences that I need to think about? Because I don't want this to be done at the last minute, right? Because a lot of times auditors are not informed, and then they find out a week before filing. And that leads to expedited fees, which adds to your already, the cost that you're paying your appraiser. So to avoid those expedited fees and to not be in a frenzy or chaos during reporting season, definitely involve your auditors when you issue these debt instruments. There are also a lot of other questions being asked about how do you factor the uncertainty of tariffs. That is going to be very subjective. A lot of times when we're valuing companies, we factor it into our discount rate called unsystematic risk, and that's the company-specific risk premium, or alpha, which includes regulatory risk. So there is some subjectivity that goes on in there that we would add to our discount rate, because markets information that we pull is historical. And since the tariffs are more forward-looking kind of regulatory uncertainty, you would add that to your company-specific risk premium, or your unsystematic risk, rather. So with that, I really want to thank Adriana. I thought you did fantastic, being extremely informative. I'm really glad you presented with me.
Thank you.
Yeah, a huge thanks to our marketing team from both of us, right? Like they got over 600 people to sign international registrants. We couldn't have done it without them. And also our technical accounting team. They tutored us after hours to make sure we're giving you the right type of technical accounting information, because there is a lot of overlap between valuation and technical accounting. And for the companies that are watching, thank you so much for joining. Don't worry about the uncertainty. Go get that funding that you need. Get your wildcard convertible debt. Be as creative as you want with the features to the extent that it favors you. And don't worry about the complexity, because we can take care of that for you. With that, I want to thank everyone and hope you have a great day.
All right. Yes, thank you, AJ and Adriana, for a great presentation today. To our audience, if you have any further questions or comments, please reach out to us, as we are happy to continue the conversation. You can drop a note in the Q&A window or reach out to AJ or Adriana directly. Their contact information is in your console as well as in the slide deck, which you can download now from the handouts window. We invite you to visit our website for more resources and information on this topic, many of which are linked in your handouts window. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate and to make it to 50 minutes. A copy of your certificate will be emailed within 3 weeks should you have any difficulty downloading it now. Finally, here is a link to a survey for today's presentation. Your feedback is always appreciated. Again, thank you for joining us, and take care, everyone.
I think we do have a little bit of time because some people are asking if you would get your CP credit. You should, but we can address one more questions that we've gotten through LinkedIn. And one of it was if your public debt was, or if your public company, your convertible debt is publicly traded, do I still need an appraiser? That depends, right? Because one is, a lot of times we've seen that if you have the publicly traded value one quarter, it's not available in the next quarter. So you still need that expert to value it for the quarters you don't have. Also, the other reason is publicly traded values on Bloomberg is only going to give you the total value. It's not going to give you the bifurcated value of the embedded derivatives. And if you don't qualify for that fair value option or ASC 825, then you would need to do the analysis to bifurcate those embedded derivatives, which will ultimately add up to the Bloomberg traded value, but you're still going to need to do that exercise. So I hope like that made up for the time.
Yeah, we got another fun one. How do you value an electric power contract? Okay, can't see the question anymore, but how do you value a power forward contract? Usually we use the income approach. So I know sometimes it's difficult coming up with future power prices in kind of the more illiquid locations, but we do have that expertise in the power markets. So we can definitely help with power contracts.
I think we can log off. I think we have answered everyone's questions. If you have more questions, please do continue sending it to us. Even if you're not online, we'll definitely answer offline, and our marketing team will make sure you get those responses. Once again, thank you so much for joining our webcast, and hope you have a good day.
Thank you. Bye.
Thank you, everyone. Thank you, AJ. Thank you, Adriana.